Welcome to the Deep Dive. We're here to help you make sense of complex stuff and turn it into knowledge you can actually use. Today, we're tackling a really big one, maybe one of the biggest life changes, making that jump from renting to owning your first home.
It's definitely a huge step. Exciting, sure, but also, well, a bit daunting with all the paperwork and decisions.
Yeah.
So our aim today is to break down the best advice out there into like a clear playbook, 4 phases.
Right. So whether you're thinking about security or maybe building some wealth or just want your own space, this should help you get ready.
Exactly. Prepared for every step of the way.
Okay, let's dive right in. The sources really hammer home this core idea, don't they? This
Yeah.
isn't just about changing addresses.
No, it fundamentally changes how your money works for you.
You stop seeing rent as just gone money month after month.
And you start thinking about mortgage payments, building equity, actual ownership.
That's the big shift, the real game changer, trading that cost for an asset, something that could grow in value.
Precisely. But managing that asset, that takes preparation, which brings us straight into phase 1, building your financial fortress.
Okay, financial fortress. Sounds serious. And the planning here, it seems like you can't skip this.
Non-negotiable. You
How?
absolutely have to get your financial ducks in a row first.
Checking your credit score, really tracking your spending, knowing your income inside out.
All of that. But there's one thing the experts really stress, even before you start aggressively saving for that down payment.
The emergency fund?
Yes, the emergency fund priority. Seriously, before you put aside a single dollar for closing costs or anything house-related, you need that safety net. We're talking 3 to 6 months of essential living expenses. Saved. Accessible.
Why so crucial before the house savings?
Because buying a house has massive upfront costs, right? Down payment, closing costs. They can wipe out savings fast. You cannot afford to drain your emergency fund just to get the keys. Homes always come with surprises. Always.
Like a leaky roof fund, basically.
Exactly. That fund is your buffer against, the worst case stuff.
Okay, so emergency fund first. Then we think about saving for the house itself. And the timeline matters here, doesn't it?
Big time. If you're looking, say, 1 to 3 years out,
Still a way off.
yeah, you might think about maybe short-term bonds or some fixed income options, trying to get a little return while you save. Carefully, though.
But if you're closer, like 6 months to a year,
Then safety is everything. You need that money liquid, protected. A high-yield savings account, FDIC insured. That's the play. No risk.
makes sense. All right, let's talk affordability. The big number everyone wants. How much house can I actually afford? It comes down to this DTI ratio.
Debt to income. Yep. That's the main metric lenders use. It's your total monthly debt payments.
Like car loans, student loans, minimum credit card payments.
Right. All that recurring stuff divided by your gross monthly income before taxes.
And what's the magic number lenders like to see? I know you can sometimes qualify higher, but what's the smart target?
Well, lenders might go up to 50%, technically. But the sources really push for aiming lower, ideally under 43%.
So, quick example. If you make $5,000 a month gross, and all your debts plus the estimated new mortgage payment add up to $2,000.
Then you're at 40%. That's a much healthier spot.
Right.
It tells the lender you've got breathing room, better financial stability.
Okay, so DTI gives us the borrowing limit, but the actual monthly payment?
Yeah, oh boy.
It's way more than just the loan repayment, isn't it?
Oh, yeah.
Yeah.
Much more complex. Think PITI. That's the acronym you need to remember.
PITI. Okay, break it down.
P is principal. That's the actual loan amount you're paying down. I is interest, what the lender charges you to borrow. T is property taxes, your local government taxes based on the home's value. And the last I is homeowner's insurance protecting the property itself.
PITI. That's the core mortgage payment.
That's the base layer. But here's something critical for first-time buyers.
Right.
How PITI is weighted, especially early on. In those first, say, 5 to 7 years of a typical 30-year mortgage, the huge chunk of your payment, maybe 70% or even more, is just going to interest.
Ouch. So you're not building much equity right away.
Not nearly as fast as you might think. That interest is front-loaded. It really slows down how quickly you own more of your home outright.
Wow. Okay, so understanding that loan structure is vital, and PITI isn't even the whole story, right? There are a couple more potential costs.
2 big ones, usually. First is PMI, private mortgage insurance.
Right, that's if you put down less than 20%.
Exactly. If your down payment is smaller, the lender sees more risk, so they require PMI. And here's the kicker. It protects the lender, not you.
Did I pay for it?
You pay for it monthly. Until you build up enough equity, usually 20%, then you can request to have it removed.
Okay, so PITI plus potentially PMI, what's the second extra cost?
The one that catches everyone off guard, maintenance, and repairs.
Ah, yes. The joys of homeownership. The sources just say, budget for it. Can we put a number on that, like a rule of thumb?
That's a great question because it's the biggest blind spot for renters becoming owners. The standard advice is pretty solid. Budget 1% to 3% of the home's purchase price per year for maintenance.
1 to 3%
Right.
annually. So on a $400,000 house.
That's $4,000 to $12,000 a year you need to have set aside. Or be ready to find for everything from a running toilet to, needing a whole new furnace someday.
That's a serious chunk of change, something you just don't think about when you're renting, and just call the landlord.
Exactly. It's a major shift in responsibility. You are the landlord now.
All right, so phase 1 is done. Financial house is in order. Emergency fund is solid. You understand PITI and PMI and maintenance costs. The sources say the next big hurdle isn't saving more money, it's actually building your team. Phase 2, assembling the A-team, starting with the lender.
Yep. And the first rule of finding a lender, forget loyalty.
Don't just walk into your regular bank where you have your checking account.
Absolutely not. You have to shop around. It's crucial. We're not just comparing the interest rate either.
What else are we comparing?
You need to look at the fees, origination fees, underwriting fees, all the little costs. How transparent are they about those fees? Also, think about the type of lender. Credit unions often have great rates. Big banks offer convenience. Online lenders can be fast. Mortgage brokers, they can shop multiple lenders for you at once.
So brokers might give you the widest comparison.
Often, yes.
Yeah.
You also want to consider their speed. How quickly can they approve you? In a hot market, that matters. And their flexibility on terms.
Okay, so shop, shop, shop. And the goal of this shopping is to get that pre-approval letter, right? Can you clarify the difference again? Pre-qualification versus pre-approval.
Good distinction to make. Pre-qualification. It's kind of like a rough estimate, based on info you provide but not verified, like asking, can I generally afford a house?
Okay. And pre-approval.
Pre-approval is the real deal. You submit a full application, they pull your credit report, they verify your income with pay stubs, tax returns, bank statements. The letter you get back says, yes, based on verified info, we are prepared to lend you this much money. It's basically a conditional commitment.
And that letter is powerful when you make an offer.
It's gold. Especially in competitive markets. It tells sellers you're serious and financially ready to go. Big advantage.
But there's a huge warning sign attached to that pre-approval, isn't there? Something that can trip people up right at the end.
Oh, absolutely. This is critical. Once you're pre-approved, you have to maintain your financial status quo. Like, freeze everything.
Meaning?
Don't go buy a new car. Don't finance furniture for the new house yet. Don't open new credit cards. Don't even change jobs if you can help it.
Why not? The loan's approved, right?
It's conditionally approved. The lender does a final check, often right before closing. Any significant change to your DTI ratio, your credit score, even your employment, it can cause the underwriter to pull the loan days before closing. It happens.
Wow. Okay. Freeze finances. Got it. Now, the other key member of the A-team, the real estate agent.
Your guide through the whole maze. Your negotiator. Your buffer.
So when you're interviewing agents, because you should interview a few, right? Beyond just asking, how long have you been doing this? Mac, what are the crucial questions? What mistakes do buyers make here?
A common mistake is focusing too much on just overall sales volume. Like how many houses they sold last year across the whole city.
What's more important?
Local market expertise. Ask them, how many homes have you helped buyers purchase in this specific neighborhood or this school district in the last 6 months? That's much more relevant.
Okay. Hyper-local knowledge. What else?
Communication style is huge. How often will they update you? How do they prefer to communicate? Text, email, phone? Make sure it matches your style. And critically, you want someone who is clearly your advocate. Are they just trying to make a quick sale? Or are they pointing out potential issues with the property? Will they push back if a seller's being unreasonable?
So they're not just opening doors, they're managing the whole process.
Exactly. They're searching databases, using their local network, setting up showings. They're pulling comparable sales data to the CMA to help you figure out a fair offer price. And they're coordinating with everyone else, the lender, the home inspector, the title company, maybe lawyers, handling tons of paperwork. They really should be insulating you from a lot of the stress.
Okay, team assembled, finance is solid. Now for the fun part, maybe.
Yeah.
Phase 3, strategic house hunting.
It can be fun, but strategy is key. The sources really emphasize structure here. Start by clearly defining your needs versus your wants.
Needs versus wants. Why is that distinction so important up front?
It prevents what some call house blindness. Falling in love with like the fancy kitchen or the cool backyard and overlooking major deal breakers.
So needs are the absolute must-haves.
Non-negotiables.
Mm.
Minimum number of bedrooms, a specific school district boundary,
Yeah.
a commute under X minutes, things you simply cannot compromise on.
And wants are the nice-to-haves.
Right. A swimming pool, maybe, a home office space, smart home features, things that would be great, but aren't essential for the house to work for you. If you start your search chasing the wants, you'll waste so much time looking at properties that don't even meet your basic needs.
Makes sense. So filter by needs first. And then there's this idea of future-proofing the purchase.
Yeah, don't just buy for your life right now. Think ahead, 5 years, 10 years down the line.
Like, are you planning on having kids? Will you need space for aging parents eventually?
Exactly. Does the house have the potential to adapt? Or will you outgrow it immediately? And think about resale value, too. Even if it feels like your forever home now, life changes. Is the neighborhood desirable? Is the property likely to appreciate?
Can you add value easily, like finishing a basement or updating a bathroom later on?
That's smart thinking. Maximizing the potential to build equity. You want an asset that can help you move up later, not something that holds you back.
Okay, this next part feels like insider knowledge. What you should actually look for during a showing versus the stuff you should totally ignore. This seems crucial for saving money and stress.
Absolutely critical. Focus on the fundamentals, the things that are either impossible or incredibly expensive to change later.
Number one being
Location, location, location. Can't stress it enough. You cannot change the location. It dictates school quality, commute, safety, noise levels, and ultimately appreciation potential.
right.
A bad location is an anchor you can't lift.
Okay, location is king. What else is in that don't ignore very expensive category?
Structural integrity. Look for signs of foundation issues, big cracks in walls or ceilings, doors that stick. Check the roof's age and condition. These are tens of thousands of dollars fixes. The home layout is another big one. Sure, you can knock down some walls, but moving load-bearing walls, that's a major costly renovation. Does the basic flow work for you?
And the guts of the house.
The mechanical systems. HVAC, how old is the furnace and AC? Plumbing, any signs of leaks, old pipes? Electrical, is the panel up to code? Are there enough outlets? Replacing these systems is disruptive and expensive.
So focus on location, structure, layout, mechanicals. These are the bones.
Those are the bones. Everything else is mostly cosmetic.
So what should we ignore? What distracts buyers but is actually easy to fix?
Oh, so many things. Ugly paint colors, terrible wallpaper. Ignore it. That's just someone else's taste. Easy fix.
Old, worn-out carpet, cluttered rooms full of weird furniture.
Ignore, ignore, ignore. Flooring is relatively cheap to replace compared to a foundation repair, and you're not buying their furniture or their clutter. Try to see past it.
What about landscaping, like an overgrown yard or dead bushes?
Cosmetic. You can fix that with some sweat equity or hiring a landscaper. Don't let a messy yard scare you off a house with great bones at a great location.
So the mantra is buy the structure, not the style.
Exactly. You can always change the style. You can't easily change the location or the foundation.
Okay, you've done the prep, built the team, hunted strategically, focused on the bones, and you found it. The one. Now comes the high-stakes part. Phase 4. Making the offer and getting to closing. Timing and strategy seem vital here.
Absolutely. You're pre-approved. You know your budget. Now, your agent needs to run that CMA, the comparative market analysis.
To see what similar homes nearby actually sold for recently.
Right. That data helps you determine a reasonable starting offer price.
Yeah.
And a smart tactic is often to offer slightly below your absolute maximum.
Why is that? To leave room to negotiate.
Exactly. Sellers might counteroffer, or maybe you'll need some wiggle room if inspection issues pop up. Don't go all in immediately unless the market absolutely demands it.
And the offer isn't just the price, right? There are other key parts. Contingencies.
Contingencies are your best friend. They're conditions that have to be met for the deal to go through, protecting you.
What's the most important one?
The home inspection contingency. This gives you a set period, maybe 7-10 days, to have a professional inspector go through the house top to bottom. If they find major problems like that bad roof we talked about or faulty wiring, this contingency lets you renegotiate the price, ask the seller for repairs, or, if it's really bad, walk away and get your deposit back.
But I hear about buyers waiving contingencies, especially inspection, to make their offers stronger in bidding wars. Risky.
Extremely risky. The sources are very clear on this. Waiving inspection might get you the house, yes, but you could be inheriting a money pit with potentially bankrupting repair costs you didn't know about.
So generally avoid waiving inspection, if at all possible.
Very strongly advised. A slightly less risky way to stand out, maybe, is adding a personal cover letter to your offer.
A letter to the seller.
Yeah, sometimes telling them a bit about yourself, why you love their home specifically, can create an emotional connection. It might tip the scales if offers are close. Can't hurt, usually.
Okay. What about earnest money?
That's your good faith deposit. Shows you're serious. Usually 1% to 3% of the purchase price. It doesn't go to the seller directly. It's held by a neutral third party, like a title company, in escrow.
And you get it back if the deal falls through because of a contingency?
Correct. Or if the seller backs out. If the deal closes successfully, that money just gets applied towards your down payment and closing costs.
All right, offer accepted. Champagne.
Not yet. Now the real sprint begins. First up, schedule that home inspection immediately.
Then deal with the title stuff?
Yep. The title company starts its work. They do a title search to make sure the seller actually owns the property free and clear, with no hidden liens or claims against it.
Liens like unpaid taxes or contractor bills.
Exactly. Then you'll purchase title insurance. This protects you and the lender against any title problems that might somehow surface after you close. It's a one-time cost at closing, and it's essential protection.
Okay, inspection done, title search underway. What's next as closing gets closer?
You need to finalize everything with your lender. Lock in your interest rate if you haven't already. And then, very importantly, you'll receive a document called the Closing Disclosure, or CD.
Closing disclosure, what is that?
It's a standard 5-page form that lays out all the final details of your loan. The loan amount, interest rate, monthly payment breakdown, PITI, and all the closing costs.
And you need to check this carefully.
Meticulously. Compare it line by line against the loan estimate document you got when you first applied. The numbers should be very similar. If there are big, unexplained differences, you need to halt things and ask your lender why immediately before closing.
Good tip, don't just sign anything. And then the final walkthrough.
Usually done 24 hours before closing. This is your last chance to check the property. Make sure the seller has moved out, that no new damage has occurred since the inspection, and crucially, that any repairs the seller agreed to make have actually been completed properly.
What if something's wrong, like the AC isn't working anymore?
You raise the issue immediately before signing. It might delay closing slightly, but you need it resolved. Don't close with outstanding issues unless you've negotiated compensation.
Okay. Finally, the closing table. What do I need to bring?
Bring your government-issued photo ID, and you'll need certified funds, usually a cashier's check, or proof of a wire transfer for your remaining down payment amount, plus all your closing costs. Your lender and title company will tell you the exact amount beforehand.
And then sign a mountain of paperwork.
Sign a mountain of paperwork, and then finally, you get the keys.
Wow. That feeling, after navigating all 4 phases, the financial checks, building the team, the strategic hunt, the offer, and closing, it must be incredible.
It really is a huge accomplishment, moving from planning to searching to negotiating and finally holding the keys to your own place, your own asset. Hashtag tag outro.
But as the sources point out, getting the keys isn't really the end of the journey, is it?
No, in many ways, it's a beginning. Homeownership brings fantastic rewards, but also new responsibilities that renting just doesn't have.
Like that ongoing maintenance budget we talked about, and, actually having to deal with neighbors sometimes.
Right. The cost and time involved in upkeep are real. And yes, being part of a neighborhood community, the advice is also to periodically review your situation. Does the house still fit your life? How's the market doing? It requires ongoing attention.
That's a fascinating point. Rent is just transactional each month. Homeownership is active management.
Yeah.
You shift from being just a consumer of housing to being the manager of a significant asset.
It's a profound shift in mindset and responsibility.
So for everyone listening who's on this path or thinking about it, here's something to chew on. As you transition from renter to owner, from consumer to asset manager, what part of that long-term planning and management responsibility are you most excited or maybe most nervous to take ownership of?